In my perspective, there has never been a more opportune time to be a high-yield dividend investor. Over the past 3.5 years, there's been a noticeable surge in companies launching new high-yielding ETF products to cater to investor demands. This trend began with newer companies like Global X, which introduced ETFs employing covered call strategies. However, the trend has since gained momentum, with even major financial institutions like BlackRock and JP Morgan entering the arena in recent years. They now offer high-yielding funds with yields exceeding 10% in some cases. This indicates a growing attraction among investors for high-yield investment strategies, which I have been a proponent of for many years. In this video, we're going to explore a brand new fund that has recently been launched, offering an exceptionally high yield. The fund in question is the KraneShares China Internet and Covered Call Strategy ETF, with the ticker symbol KLIP. This ETF aims to provide current income by purchasing the KraneShares CSI China Internet ETF, ticker KWEB, and selling covered calls on it. KWEB consists of Chinese companies primarily focused on Internet and Internet-related technologies. These companies are publicly traded on the Hong Kong Stock Exchange, NASDAQ, or the New York Stock Exchange. KWEB offers exposure to companies capitalizing on China's growing middle-class consumption, making it a compelling investment option. KLIP currently offers an impressive 57.35% dividend yield and pays dividends on a monthly basis. This high yield has generated significant interest, prompting requests for a review of this ETF. It's reminiscent of the high-yield strategies seen in other ETFs like TSLY and NVDY. KLIP is a relatively new fund launched earlier this year, making it still relatively undiscovered by many investors. At 57.35%, it's one of the highest-yielding ETFs available, particularly for those who favor high-yield investments. Now, let's delve deeper into KLIP and assess whether it's a viable monthly income fund worthy of consideration for our portfolios. One distinctive feature of this fund is that it appears to hold only one primary asset. It primarily holds the KraneShares CSI Internet ETF, and the remaining assets are in cash or related call options. Therefore, a significant portion of this video will be dedicated to analyzing KWEB. KWEB is a portfolio of 31 Chinese internet and e-commerce companies. The top 5 holdings represent approximately 41% of the fund's portfolio. Recognizable companies within the fund include Alibaba, JD, Tencent, and Baidu. However, some of the holdings might be unfamiliar to many investors, given the international nature of these companies. While stocks on the NYSE and NASDAQ must adhere to reporting standards, the standards of the Hong Kong Stock Exchange may differ. This can create challenges in analyzing these companies, especially if you are not well-versed in the economic and political landscape of the region. Political risk is another consideration when investing in foreign companies, as understanding the political and economic context of the countries involved is crucial. Therefore, it's essential to have confidence in the fund manager's understanding of these regions. The head portfolio manager of this ETF previously worked in the ETF Global Capital Markets Group at State Street for 9 years. While it's not clear how much of that time was spent specifically on Chinese companies, performance remains the most critical factor. Analyzing KWEB's performance, we observe a history of growth in its early years, followed by fluctuations and downturns. More recently, the fund's performance has plateaued. The fund has faced challenges but remains profitable due to its high dividend yield, which is maintained by writing covered call options on KWEB. Unfortunately, KLIP was launched during a challenging time for Chinese internet companies, leading to a decline in its share price since its inception in January. Nonetheless, its exceptional dividend yield compensates for the falling share price. Reinvesting dividends has shown that KLIP can still be a profitable investment. Using a DRIP calculator, a $10,000 investment in KLIP at its launch would have yielded a total return of 6.84% in just 8 months. Even without reinvesting dividends, it would still have generated a positive return of 4.47%, despite the substantial share price decline. KLIP pays dividends through selling covered call options on KWEB, providing a reliable income stream. It's important to understand that, due to the nature of these funds, they have caps on potential share price growth. Thus, the share price of KLIP may not rise to the same extent as its underlying security, KWEB, when the market is bullish. In summary, KLIP offers both advantages and disadvantages. Reinvesting dividends can make it a highly profitable investment. However, its focus on a specific sector in a foreign market makes it a riskier holding. Before making any investment decisions, it's crucial to conduct thorough research and assess whether KLIP aligns with your financial goals and risk tolerance. Thank you for joining us for this in-depth look at KLIP. If you enjoyed this video, please consider subscribing to our channel and hitting the like button. Feel free to check out our Patreon for monthly updates on my holdings and access to our Discord channel for discussions on high-yield investment strategies. Your support is greatly appreciated. Until next time, take care and happy investing.